If you're holding silver right now, you need to stop scrolling and watch this, because something just happened in the data this week that almost nobody on financial media is talking about. And if it means what I think it means, it changes the entire posture for every single silver holder watching this video. Today is Saturday, April 25th, 2026. As I'm recording this, silver is sitting between $75 and $78 an ounce, down 38% from the all-time high of 121.64. It hit on January 29th of this year. Most people are looking at that chart and concluding one thing: the silver run is over. The bubble popped. Time to move on. I'm going to show you why those people are wrong, and I'm going to do it using one single number that came out of China this week: 836 tons. That is how much silver China imported in the month of March alone, according to Chinese Customs Authority data confirmed by Bloomberg, Reuters, and Kitco. It is an all-time record. It is 78% higher than February 2026, which itself was the highest February on record. And here is the number that should make every silver holder pay attention. It came in 173% above the 10-year seasonal average for March. Year to date, China's 2026 silver imports have hit roughly 1,626 tons. Also a record. The world's largest silver consumer is buying physical silver at a pace that has never happened before in the modern era of Chinese trade data, while the Western paper price has dropped nearly 40% from its high. Those two facts cannot both be true unless something is fundamentally broken about how silver is being priced right now. In the next 25 minutes, I'm going to walk you through exactly what this signal means, the two completely separate buyer groups inside China that drove this spike at the same time, the FOMC meeting in 4 days that could be the biggest catalyst silver sees this quarter, and what the historical playbook says happens next when physical demand and paper prices diverge this hard. Quick note before we go in: nothing in this video is financial advice. Silver is one of the most volatile assets you can own. It just dropped 40% in 90 days. It can do that again. Talk to a qualified advisor who knows your situation. I'm here to walk you through what the data is showing. What you do with it is on you. Let's get into it. Let me explain why the 836-ton number is the most important data point in the silver market this month. In a normal world, China imports somewhere around 300 tons of silver in March. That's the 10-year seasonal average. Chinese silver imports follow industrial demand cycles. Factories order what they need, retail demand fills in around the edges, monthly numbers stay relatively stable. This March, China imported almost 3 times the seasonal average, 836 tons. That's not noise. That's not a small spike. That's a structural break. And here's what makes it genuinely unusual. 2 completely different buyer groups drove it at the same time, independently, without coordinating. Their motivations had nothing to do with each other. They just happened to converge in the same month. When gold hit nearly $5,500 an ounce earlier this year, it became too expensive for tens of millions of ordinary Chinese savers. In China, owning physical metal isn't a niche investor habit. It's a mainstream way of saving money, like owning a savings bond in the US or putting cash in a cash ISA in the UK. Regular people do it. When the primary metal, gold, ran out of reach, those savers didn't stop saving. They just switched assets. They started buying silver bars instead. In the Shuibei market in Shenzhen, China's main retail bullion district, sales of 20 gram to 1 kilogram silver bars exploded. This wasn't speculation. This was Chinese households substituting silver for gold because gold got priced out. China dominates global solar panel production. The solar industry alone consumes about 20% of total annual global silver supply. And on April 1st, 2026, China removed its export tax rebates on finished solar panels. That made finished panels significantly more expensive to export starting that day. So in March, every Chinese solar manufacturer raced to ship as much product as possible before the deadline. Producing more panels faster means consuming more silver faster. Industrial necessity. They had to buy. Price didn't matter. They were racing a calendar. Now think about what happened structurally. One monetary buyer, one industrial buyer, both pulling on the same physical silver supply at the same moment. And the result was 836 tons of silver vacuumed out of global markets in 31 days. Most of it pulled through Hong Kong, where, by the way, premiums on large silver bars hit $8 an ounce earlier this year, when those bars normally trade at a discount to the London benchmark. Now, I have to be fair about this. Some of the March surge was a one-time event. The solar manufacturers were front-loading because of the April 1st deadline. That demand was borrowed from April and May, so when the April customs data comes out, it's likely going to show imports pulling back as the solar rush ends. But here's what doesn't go away: the retail substitution from gold to silver. That trend is structural. As long as gold stays above $4,500 an ounce, ordinary Chinese savers are going to keep stepping down the metal ladder into silver. And gold is currently sitting around $4,800. There is no signal that's reversing. So even if we strip out the industrial front-loading, The underlying retail demand from China is still running well above seasonal norms. The floor is being built quietly, methodically, ton by ton. This is the part most analysts skip, and it's the part that confuses most retail investors. Here's the obvious question. If Chinese demand was that strong in March, why did the spot price of silver drop instead of going up? The answer is the most important thing to understand about how silver is actually priced. Silver has two prices that run simultaneously, always, every single trading day. The first is the paper price, the number you see on CNBC, the number on your trading app, the number quoted in every silver headline. That price is set in COMEX futures in New York and LBMA spot pricing in London. It moves based on rate expectations, some dollar strength, geopolitical headlines, hedge fund positioning, and algorithmic trading. It is fast, it overshoots, and it can stay disconnected from physical reality for extended periods. The second is the physical price, what industrial buyers actually pay when they need real metal delivered, what refiners charge for 1,000-ounce bars in London, what buyers in Shanghai pay in cash for silver they take home that day. That price is set by real supply and real demand on real metal. In a healthy market, those two prices stay close, within a few cents of each other. The arbitrage system makes sure of it. If physical silver is more expensive than paper silver, traders buy paper, take delivery, sell physical, pocket the spread. The gap closes within hours. Right now, that system is breaking. Physical silver in Shanghai has been trading at premiums of 10 to 15% above international paper benchmarks for months. London's silver lease rates, the cost to borrow physical silver, have been running well above their historical norm of under 1%. COMEX registered inventory dropped 31% in just a few months earlier this year. Every single one of those data points is a symptom of the same problem. The physical market is way tighter than the paper price suggests. So why did paper silver drop while physical demand exploded? 3 reasons. 1, the dollar got stronger. A firm dollar makes silver more expensive than every other currency, which compresses international demand at the futures level. The dollar is strong right now because of Iran-related oil pressure, keeping inflation expectations elevated, which keeps the Fed from cutting, which supports the dollar. That entire chain hangs on one specific event. 2, the CME hiked margin requirements. When silver was running toward $121, the exchange that operates COMEX raised the cost to hold leveraged silver positions. Traders who were levered long got margin called, forced to sell. The selling cascaded into more selling. Classic squeeze unwind. 3, profit taking. Silver had run up 147% in 2025. After a move like that, ordinary profit taking on its own can produce a 20 or 30% correction without anything actually changing about the underlying story. So here's what really happened. The paper market got slammed by macro headwinds and forced liquidation. Meanwhile, the physical market kept tightening. The gap between the two widened. Right now, paper silver and physical silver are telling you very different stories about what silver is worth. History is extremely clear about how that gap resolves, every single time. Hit the like button if this is starting to make sense. It helps the algorithm push this to other people trying to figure out what's happening. Now let's talk about the calendar event that could move silver more than anything else this quarter. On Tuesday and Wednesday, April 28th and 29, the Federal Open Market Committee meets in Washington. The policy statement comes out at 2 p.m. Eastern on Wednesday. Jerome Powell's press conference starts at 2:30 p.m. This is Powell's last FOMC meeting as Federal Reserve Chair. His term ends in May. Kevin Warsh is widely expected to replace him, and that context matters more than most people realize. According to CME FedWatch, the probability of a rate cut at this meeting is essentially 0. Rates are going to hold at 3.50% to 3.75%. That's almost completely priced in. So the rate decision itself isn't the story. The story is what Powell says. This is his last press conference as Fed chair. He's going to be standing in front of a room full of reporters who know it's his last one. The economy is showing signs of slowing. The IMF just cut its global growth forecast to 3.1%. Q4 2025 GDP came in at just 0.5% on the third revision, way lower than the 1.4% advance estimate. That kind of downward GDP revision is the type of data that historically forces the Fed to acknowledge weakness. And Powell knows that whatever he says in this press conference becomes the framework Kevin Warsh inherits. Here are the 4 specific things to listen for, because each of them moves silver differently. 1. Does Powell distinguish between energy-driven inflation and demand-driven inflation? This is the most important word watching exercise in the entire press conference. If he acknowledges that the current inflation surge is being driven by oil prices, not by overheated demand, he's giving himself the linguistic flexibility to cut later when oil normalizes. That language is dovish. It would directly support silver. 2. Does he mention slowing global growth as a factor the Fed is monitoring? If Powell brings up the IMF forecast cut, the weakening Chinese economy, or any signs of European softness, he's signaling that the Fed sees external risks to U.S. growth. That's dovish. 3. Does he push back hard against rate cut expectations? If Powell says something like, the Fed has no visibility on cutting given current inflation, or emphasizes labor market strength, that's hawkish. That would push the dollar up, which would push silver down in the short term. 4. Does he use the phrase data dependent in the context of potential easing? That phrase in this exact environment is a soft green light. It means the Fed is open to cutting if the data softens. Markets would read that as dovish. Bank of America's economists have been arguing for weeks that markets are underpricing how dovish Powell could be at his exit meeting. Morgan Stanley's chief U.S. economist still expects the Fed to cut as soon as Powell departs, possibly at Warsh's first or second meeting. If Powell goes even slightly dovish on Wednesday, silver could move 4 to 6% in a single afternoon. Up. If he goes hawkish, silver tests $72 on the downside. This press conference is the single most important catalyst for silver between now and June. The 836-ton China import number doesn't stand alone. It sits inside a cluster of other signals, all pointing the same direction. And when multiple independent signals point the same way, that's when you start paying serious attention. Confirmation 1. The gold to silver ratio is elevated. Gold is currently around $4,800. Silver is around $77. That makes the gold to silver ratio roughly 62 to 1. The modern long-term average sits closer to 47. The geological ratio of how silver and gold actually exist in the Earth's crust is about 8 to 1. Historically, every time the gold to silver ratio has been this elevated heading into a Fed pivot cycle, silver has dramatically outperformed gold over the following 12 to 24 months. Not occasionally, consistently. The ratio is what's called a slow signal. It tells you about months and quarters, not days. But it's pointing strongly towards silver outperformance. Confirmation 2. Jobless claims are creeping up. This week's initial jobless claims came in at 214,000, up 6,000 from the prior week's 208,000. Slightly above the consensus expectation of about 210,000. That single number isn't alarming, but the direction is what matters. Claims have been ticking up slowly for several weeks. That trend is exactly what the Fed needs to see to justify pivoting. The Fed doesn't need a recession to start cutting. It just needs to see that the labor market is no longer absorbing the drag of restrictive policy. That process has begun, quietly, in the data. Confirmation 3. U.S. interest payments now exceed military spending. This is one of those slow-moving fiscal facts that almost nobody talks about because it doesn't make for clickable headlines. But it's structurally enormous. U.S. interest payments on the national debt have officially crossed the line where they exceed the entire U.S. defense budget. That milestone changes the political calculus around long-term monetary policy. When interest payments are larger than military spending, the federal government has a powerful incentive to either inflate the debt away or eventually pursue easier monetary policy. Both of those outcomes are good for hard assets like gold and silver. This isn't an immediate catalyst, but it's a structural tailwind that gets stronger every quarter. Confirmation 4. Silver ETF momentum is rebuilding. SLV, the largest silver ETF, has seen its momentum score climb back into the upper percentiles based on Benzinga's analysis. SkyVR, the lower-cost silver ETF, shows a similar pattern. ETF momentum in silver typically precedes retail investor flows. It means institutional capital is quietly building positions ahead of the wave, not retail piling in at a top. Institutions accumulating before retail wakes up. Confirmation 5. 6 straight years of supply deficit. The Silver Institute, working with London consultancy Metals Focus, projects the world will consume about 67 million ounces more silver than it mines in 2026. That's 6 consecutive years of deficit. The cumulative 5-year deficit is now climbing above 800 million ounces. That's an entire year of global silver mine output, gone, drawn down from above-ground inventories, and no major new silver mines are expected to come online before 2033. 5 different signals, 5 different sources, 5 different time horizons, all pointing in the same direction as the China import data. That's not coincidence, that's a confirmation cluster. Let me give you the 3 concrete scenarios I'm watching for silver between now and Memorial Day. Specific conditions, specific price levels, so you have a framework instead of just vibes. Scenario 1, bullish breakout. What needs to happen? Powell goes dovish on Wednesday. He uses language acknowledging energy-driven inflation as separate from demand-driven inflation. He mentions global growth slowing. He drops data-dependent in a forward-looking context. The dollar softens. Real yields tick down. And separately, there's any progress on Iran diplomacy. Even a rumor of resumed talks pulls oil down from $95 plus and takes the top off inflation expectations. Under those conditions, silver breaks above $80 cleanly, targets $80 to $85. A weekly close above $85 would be a major technical signal that the correction from $121 is over and the next leg has begun. First meaningful target on that leg sits at $92 to $95. Scenario 2, sideways consolidation. What needs to happen? Powell stays carefully neutral. The Iran situation neither escalates nor resolves. Oil bounces between $90 and $100. The dollar stays firm but doesn't break to new highs. Under those conditions, silver consolidates between $72 and $82 for the next 4 to 6 weeks. This scenario is the most boring and the most likely. Markets often spend more time digesting big moves than making them. Frustrating to hold through, but not the end of the structural story. Scenario 3, short-term breakdown. What needs to happen? Powell sounds hawkish on Wednesday. He emphasizes inflation persistence. He pushes back on rate cut expectations. The dollar spikes. Iran situation gets worse. New naval incident in the Strait of Hormuz. Oil pushes above $100. Under those conditions, silver tests $72 to $74. That zone has now been tested twice and held. A weekly close below $72 would be a warning that the base is failing. Below $70 on a weekly close means you have to fully reassess the near-term thesis. Now here's what I want you to notice. None of these 3 scenarios changes what China is doing with its silver imports. None of them restarts silver mine production in the next 12 months. None of them closes the supply deficit. None of them rebuilds the COMEX inventory that got drained in January. All 3 scenarios are about the paper market, the macro weather system silver is sitting inside. The physical reality underneath keeps pointing the same direction regardless of which scenario plays out. All right, specific framework for 3 different positions you might be in right now. If you bought silver in the 40s or 50s during 2025, you're sitting on significant gains even at $77. Your psychological challenge isn't fear of loss. It's fear of giving back gains. That nagging voice asking, should I have sold at 121? Did I miss the peak? Here's the framework. The signal cluster we just walked through, the China imports, the COMEX tightness, the FOMC setup, the ratio signal, none of it suggests the structural story is over. It suggests the story is in a pause being held down by specific macro headwinds tied to specific events with specific endpoints. Selling here is a bet that those specific headwinds are permanent. The data doesn't support that bet. If you bought silver between $80 and $121, you're showing a paper loss. Your psychological challenge is the opposite. The temptation to sell at a loss just to stop the discomfort, to convert an uncertain paper loss into a certain real one. Here's what to remember. Silver moved from $31 to $121 in 12 months last year. That wasn't ancient history. That was this year. If the structural forces that drove that move are still intact, and the signal cluster suggests they are, the question isn't whether the price recovers. The question is whether you have the patience to be there when it does. If you're thinking about adding to your position at $77, your challenge is doubt. After a 38% drawdown, buying more feels like ignoring the evidence the market just handed you. Here's the framework. Silver has now tested support twice in the $67 to $74 zone. That's a double bottom in technical terms. In a structurally tight market with this many confirmation signals, a double bottom test is typically a base, not a breakdown. But, and this matters, sizing is everything in volatile assets. Silver moves 3x gold's percentage in either direction. If you're going to add at these levels, size the position so you can sleep at night through another 20% drawdown, because that's possible, even in a structurally bullish market. The people who made extraordinary returns in silver's run from $31 to $121 last year mostly didn't buy at $31. They bought somewhere in the 40s, 50s, or 60s, into uncertainty, into noise, into a market that didn't feel like a sure thing. They bought when the signal was clear to people who were looking and invisible to everyone else. I'm not going to close this video without naming the real risks, because anyone giving you only the bull case is selling you something. Risk 1. The China import surge was partly a timing event. The April 1st solar tax rebate deadline pulled industrial demand forward. April and May import numbers will likely come down sharply as that front-loading reverses. When those numbers print, headlines are going to say, Chinese silver demand collapses. That's not what's happening. It's just timing. But it'll feel like a bearish signal. Risk 2. Prolonged stalemate. The Iran situation could stay frozen for months, not escalating, not resolving. In that environment, oil stays elevated, inflation stays sticky, the Fed stays on hold. Silver could grind sideways between $72 and $83 for 6 months before any clear directional move that's not catastrophic. but it tests patience severely. Risks 3, hard landing. If the Fed's prolonged rate hold tips the global economy into actual recession, industrial demand for silver falls faster than investment demand rises. About 60% of total silver demand is industrial. In a real global recession, that side contracts hard. Silver could revisit $60 to $65 before monetary easing stabilizes it. Risk 4, narrative reversal. If crypto, AI stocks, or another asset class starts absorbing the capital that would otherwise flow to silver, the investment demand thesis gets delayed, possibly by years. Hold these risks alongside the bull signals. That's what real analysis looks like, not a straight line up. An honest accounting of forces on both sides. Let me bring this back to where we started. China imported 836 tons of silver in March, 173% above the 10-year seasonal average. Year-to-date imports are the highest on record. The world's largest silver consumer is buying physical metal at a pace that has never happened before, while the Western paper price sits 38% below its all-time high. Powell's last FOMC meeting hits in 4 days. Any dovish inflection in his language is a direct tailwind for silver. The gold-to-silver ratio is elevated, jobless claims are softening, ETF momentum is rebuilding, COMEX inventory is at decade lows, and the Silver Institute just confirmed the 6th straight year of structural deficit, with no new mine supply coming before 2033. The loudest narrative right now is that silver had its move and the story is over. The data doesn't support that narrative. The data suggests we're in a consolidation period that will frustrate impatient holders and reward people who understand what's actually building underneath the price. I want to hear from you. Drop your read on Powell's language in the comments. What do you expect him to say on Wednesday? Dovish, hawkish, carefully neutral? And what's your silver target by the end of 2026? I read every single comment, and the comment section on these videos is honestly the best part of running this channel. If this breakdown helped you understand a signal that deserved more attention than it got, do me a favor. Hit subscribe. Share it with one person you know who's holding silver and trying to make sense of this market. The next 30 days are going to be a wild ride, and I'm going to be here breaking down every piece of it. FOMC reaction, China import data, COMEX inventory updates, all of it. The video on screen right now is my full breakdown on the $300 silver framework. Watch that next, because it gives you the long-term picture that today's video sits inside. Stay disciplined. Stay skeptical of anyone promising you easy money. And I'll see you in the next one.